Hi folks, this is Sean Hyman from Chart of the Day, and I just want to talk to you about how to interpret near-term trends in light of long-term trends. And I want to show you a prime example of what I mean by that. This is a 5-minute chart of euro dollar, and uh, here was Friday's activity. This started off Sunday, and then on into Monday, because each candle is 5 minutes in length. And there was a huge gap here, and it shows as one long 5-minute candle. But what happened is the price on Sunday evening instantly gapped from Friday's closing price here at just under 135 all the way up to 136.45. So basically about 150 pip gap. Now that doesn't happen every day. Gaps don't happen every day in the Forex market, and usually when they do, they happen usually between Friday and Sunday when the market tends to shut down and reopen back on Sunday. And so this gap up and move upward would tend to make somebody want to just hop on and go long and be a buyer when this gap's up. But I want to show you something and teach you how to make money and how to visualize something as a pro would. I want to take the same chart, but I want to look at a different time frame. I want to look at the euro dollar on the daily time frame, and I want to put a parameter on here that makes it to where it shows me what the trend is no matter what. And the trend is the 50 period, and then since it's on a daily chart, this would make it the 50-day SMA, simple moving average. And it's this black line that we've got here. And this black line has been headed downward for months now. And when we got this spike that was we've shown on the 5-minute chart, will show up like it looks like this on the daily chart. It spiked up, and then today's candle, the day that I'm recording this, closes below the SMA. And even if we get a candle that comes up a little further, what the pro's looking to do is still looking for a reason to get short, because the trends won't turn on a dime. If you'll notice, like this didn't go instantly from uptrend to downtrend. It took a while. It took several stabs. Even when it was topping out, it took a stab here, then moved up again, then moved up again, then moved up again. Then finally, it switches gears. And so really what happens is you have a hard move up and then somewhat of a sideways move when it's still trying to push upward more. And then finally, after a number of attempts, it will finally fall under the moving average and head lower. What we have here is simply the same thing. We want to keep this in mind. The bias here is short. On average, the days are moving downward rather than higher. Meaning that there's more red candles than blue, or that the red candles are moving further than the blue candles are. So statistically, probability-wise, we want to stay on the short side of the trade. And so what we want to do is look for a topping period in the short term, so that when the short-term chart starts to turn down in line with this long-term chart, then we know we've got the near-term and long-term order flow happening in our favor. And so going back to that, and you can look at many different time frames. You don't have to be on a 5-minute chart. You can be on something like a hourly 30-day chart if you wish. All right, so let me pull these indicators and lines off of here. And so what we have is the move upward on the hourly chart. So what we're looking for is for this to do a U-turn and head back down south, like we see here, like we've seen here, like we see in here. We're looking for a turn down. So if we see a turn down in the near term, whatever it is you're trading off of, you want to see the trend turn down. And how do you do that? I mean, you can just draw a trend line, or you can use one of those SMAs we talked about. So you can draw a trend line. When that trend line breaks and it's time to get short in the near term, you can have comfort in knowing that you have a high probability trade, because you've gotten short not only in the near term, but the long term momentum and trend direction is that way as well. And we can take a look, bring our daily chart back up here, and I'll bring it to an hourly so that you can see what a 50 SMA would look like there. What you want to look for is when the price starts to hold below the 50 SMA. That's when you know you've got a great compelling short. It's not a promise. It's not, every single trade won't be a winner, but many of them will be. You can do this on a 4 hour as well. Your 1 hour is going to give you a quicker turn, of course, but anytime your price starts trading and holding below your SMA, then you're good to go. But I like the hourly because it's going to turn a little quicker. But you can do this on any number of time frames. You can go down to the 15-minute chart, for instance, and still keep your 50 SMA on there. And when you see it start to, hold below the moving average, that's when you can get short. As the pair, falls, you can move your stop down a little past break even. If the pair, rallies up again and stops you out, at least you've got a little profit. And look for it to turn down again, because one of your turns down will be the real turn that you want to be on to head lower in the direction of the main trend. So sometimes it'll take a couple stabs at it. Like for instance, here was a move up, and it moved and started holding below the line, so you go short, and it trades a little lower, and you've moved your stop a little past break even. When it shoots up through this, it triggers your stop, but it gives you a little bit of a meager profit anyway. It shoots up again, and then you wait for the price to fall and start to hold back below your moving average again. Once it does, then you go short again with your stop up, well above it, and as it starts moving in your favor, you move your stop down again. Well, now since your stop's way up here, even though it's past break even some of your subsequent rallies upward are still far from your stop, and so you can ride this thing on down. Once it gets down quite a bit more, then you can move your stop on down some more, allow it to ride it down some more, and then move your stop on down some more, etc., and squeeze everything you can out of this move until you see a concerted effort to where the price finally has risen above and is starting to completely hold above the moving average. So that's how you can use near-term and long-term outlooks to your advantage. This is what the pros do. This is what I look for when I'm trading currency crosses in the Currency Cross Trader Service. I like it on currency crosses even better because they move more and they move quicker than the majors do. So like an Aussie yen is going to move a lot more than a euro dollar is going to move, for instance. Matter of fact, about twice as much many days. And so I'll get more movement and more pips out of that. It'll trend stronger. It'll trend harder. These moving averages will respond even better, and it'll come out even easier for me to be able to see the end result activity that I'm looking for. So I hope you've learned something here today, and I encourage you to check us out at worldcurrencywatch.com and ask our customer service team, Jesse or Sarah or some of the others on the customer service team about World Currency Watch's Currency Cross Trader Service with Sean Hyman, and we can get you started in getting exact trading recommendations to where you'll get exact entries, exact exits, exact stops, exact profit taking points, exact number of lots to trade per X amount of money in your account, etc. Because what that gives you is some hand holding, some mentoring. It gives you a template, if you will, to go by so that you can learn how to do this later on for yourself. But you learn best by doing, and not only do you learn best by doing, but you learn best by doing as you see somebody that's been doing it longer than you do it as well. Some of the best building and construction that has ever gone on in the construction business have been with people who have gone through an apprentice program. And once you've served through a certain apprentice program, then you are qualified to start laying your own bricks or concrete or whatever. And it's the same way in trading. Everybody really needs a mentor. It's just some realize it and some don't. But the ones that realize it are really the ones that end up very successful. I've had my own share of mentors through professionals in the industry and books I've read, courses I've taken, etc. But I learned the most from the traders that I've worked around that were the professionals that had been doing it a whole lot longer than I had. And that's really where I gained and gleaned the most. And so that's really what you'll get out of the Currency Cross Trader Service, along with your recommendations. You'll learn why I'm doing what I'm doing and what I'm looking at, what's formulating my decisions, not just buy here, sell here, stop here, but the whys of why I'm doing it, because one day that makes it to where you can do that on your own as well, and you'll know the whys behind it also. Hey, thanks so much for watching. Bye-bye.